Welcome back to my YouTube channel. I'm Jason Hubbard with eXp Realty, your trusted real estate agent, real estate appraiser, and real estate investor. Today we're tackling a topic that's crucial for investors and homeowners alike, the capital gains tax. So what is it and how does it work? Let's jump in. First off, what exactly is the capital gains tax? Simply put, it's a government fee on the earnings that you make from your investments, such as stocks or real estate. These earnings are referred to as your capital gain. You'll pay capital gains tax in the tax year that you sell the asset, and the rate you pay depends on how long you've owned the asset and your income. Let's break it down further with some key takeaways. Short-term versus long-term. You'll pay short-term capital gains tax if you own the asset for 1 year or less. Long-term rates, which are more favorable, apply to investments held for more than 1 year. Capital losses. Don't forget about capital losses. They can offset your capital gains, and if your losses exceed your gains, you can use them to offset your wages from work. Now, let's talk about how capital gains taxes actually work. The tax is triggered only when you sell your investments. This means you won't owe tax while your stock or your real estate appreciates inside your portfolio. However, once you decide to sell, the profit you make must be reported on your tax return, and you'll pay a tax on that profit at the capital gains rate. Here's a critical point to remember. Short-term capital gains have a higher tax rate than long-term capital gains. This difference is intentional and aims to discourage short-term trading, which can increase market volatility and transaction fees for investors. Let's break this down with an example. Say you buy 10 shares of a stock for $10 each, totaling $100. A bit more than a year later, you sell those 10 shares for $12 each, making $120. You've earned $20 in capital gains. Since you held this investment for over a year, these gains are classified as long-term capital gains. Now, here's the good news. If you have capital losses, whether short-term or long-term, they can offset those capital gains. If your long-term capital losses exceed your long-term capital gains, you have a net capital loss. You can also use these losses to offset other income like your wages. Now, the question, do you have to pay capital gains? The answer depends on your income. In the United States, the top 1% of earners pay a significant portion of capital gains taxes. For those who rely on investment income, they might end up paying a lower income tax rate than many salaried employees. Real quick, if you want to learn about 1031 exchanges, click the link above and watch my video to help you understand what they are and how they work. Now, let's get back into the capital gains. The capital gains tax rate varies depending on whether your gains are short-term or long-term. Short-term gains are taxed at your regular income tax rate, while long-term gains, however, have their own tax rates. Let's take a look at the 2023 long-term capital gains tax rates. Okay, stick with me here because we're going to talk some numbers. If your taxable income is up to $44,625,000 for single filers, you typically pay 0% in capital gains tax. Taxable incomes between $44,626 and $492,300 for single filers fall into the 15% tax rate. Taxable incomes of $492,301 or more are taxed at 20%. To wrap things up, understanding the capital gains tax is essential for anyone involved in investments or real estate. It can significantly impact your financial picture, so knowing the rules and the rates are crucial. If you found this video helpful at all, make sure to hit the like button, hit the subscribe button, and remember to consult with a tax professional for personalized advice on your capital gains tax. Everybody's situation is different, and it's important to get that information from a professional. Thank you for joining me today on my YouTube channel. I'll see you in the next video where we'll continue to demystify finance and real estate topics. Until then, take care and invest wisely.